Hi, and welcome to Hire Your Family. I hear from accountants all the time that they struggle with how to discuss things like this with their clients and still get them excited about the possibilities of doing tax planning. So for that reason, I'm going to be explaining this strategy just how I'd explain it to my clients to give you some ideas. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will be too. Now, I'm sure you see lots of families in your practice, and for some people that might look like a mom, a dad, and younger children. Other clients might have teenagers and college students that are on a quest for independence. You might have clients that are the strength and security for their parents as they grow older. They might have adored siblings, nieces and nephews. Families can be lots of different shapes and sizes. There's also, not to be forgotten, some families that are forged by love and choice. No genetic bonds are necessary. Every relationship takes time and some financial resources to build and maintain. So I'm going to be talking to you today about some nuances of the tax code that allow your clients to financially help those that they love while strengthening their bottom line. It's really time for people to think about hiring their spouse. Now, this gets confusing because if you think about it, you have two spouses that are filing joint, and let's say the business pays one spouse or both. The business gets the deduction, and now we have that same income reported on the tax return. So what's the point? Well, the point isn't necessarily to pay your spouse a bunch of cash, but rather pay them with deductible fringe benefits. Because when you deduct fringe benefits, and those benefits are tax-free to the spouse, the business gets the write-off and the couple gets the savings. Now, fringe benefits are additions to compensation that are given to employees to either increase their salary or boost job satisfaction. Some are taxable, but we want to focus on taking advantage of those fringe benefits that reduce taxes. So when someone has their spouse as a paid employee, it opens the door to take advantage of these types of IRS-approved benefits. Now, of course, they have to be doing bona fide work. They have to really work in the business. Now, here's some ideas of some tax-free fringe benefits. Things like medical insurance and care, education assistance, cell phone, life insurance, vehicle deductions, travel. When you hire your spouse, you're able to benefit the company and personal financial situation, and you do this greatly through a couple of different techniques. One huge fringe benefit that you want to take advantage of is through medical insurance and medical expenses. There's no real secret here. Most people are aware that you can deduct medical expenses as an itemized deduction, but this really is compounded through the self-employed. The self-employed health insurance deduction allows many self-employed individuals to deduct premiums they pay, including things like medical, dental, and vision, qualified long-term care insurance, and even Medicare premiums. Now, when you qualify, you can deduct the premiums you pay for yourself, for your spouse, your dependents, and that can include children under age 26, even when they aren't dependents. Here are some of the rules. Deducting your premiums cannot create a loss in the business. This also applies to long-term care. Normally, there are three factors to deduct your medical expenses on the personal side of your income tax return. First, the expenses have to be greater than 7.5% of your adjusted gross income. Second, the expenses must treat a medical condition or illness. And third, many over-the-counter expenses must have a doctor's prescription or letter for them. The problem here is that the medical expenses probably don't exceed 7.5% of AGI. So other than insurance, you're either out-of-pocket expenses are not deductible or very little are deductible. So right now, you can only deduct most medical costs after the expenses exceed 7.5% of AGI. and that is only if you itemize deductions. So the idea here is to really look at how you can get that medical expense deducted as a business expense. Now, wouldn't it be great if you could write off those medical expenses as a business expense? Well, the smart business owners do. No deductibles, no thresholds, and it reduces all factors of tax. No Social Security, no Medicare taxes, no income or state taxes. This is what the very wealthy have been doing for many, many years. So let's talk about some ways to get started in this. So you can set up smart healthcare plans and policies that allow almost all medical expenses to be deductible, and that is significantly going to improve the tax savings outlook. So I want you to consider some of these ideas here, and once this is set up, you can deduct not just premiums, but prescriptions, deductibles, office visits, and out-of-pocket expenses. Now, there are two ways to do this. You don't have to worry about thresholds. You don't have to exceed deductibles or anything. This is a huge opportunity. The first option is a self-insured medical reimbursement plan. It's sometimes known as an MRA or a health reimbursement arrangement or HRA. The second idea is a health savings account or HSA, and you can actually do both. But first of all, let's talk about the HRA or health reimbursement arrangement. It's otherwise known as a self-insured medical reimbursement plan. Now, what is an HRA and how does it work? An HRA is where you have a written agreement whereby you agree to reimburse your employee. In this case, it would be your spouse, and you reimburse them for medical expenses or things that aren't covered by insurance. Now, in order to do that, your spouse has to be an employee in your business, or you have to be a regular C corporation. This doesn't work if you're a sole proprietor or a partner in a partnership. So that's step number one, is to hire your spouse. Now, when they are your employee and you create that HRA, your business is now in a position to reimburse them for medical costs for themselves and their families, which includes the business owner. Those expenses are now way more valuable as a business deduction than deducted as a personal medical cost. Now, the second step is that your spouse will be the primary provider of the medical insurance, electing family coverage on this written plan. The spouse is electing to cover all members of the family. And who are members of the family? You and your dependent children. Finally, in step 3, the HRA reimburses all employees, which includes your spouse, medical expenses that are not covered by insurance. Things like deductibles, co-pays, eyeglasses, insurance, etc. Now you, the business, get a deduction, and they get the money for the medical expenses tax-free. Now, the most interesting part about this is, why is it tax-free? It's tax-free because the IRS says it's a tax-free fringe benefit. But the catch is, you have to hire the spouse in the business, otherwise it doesn't count. What are some medical expenses that you can reimburse? There are so many things that you can cover. You can push pause and take a look at this list. It's mind-boggling just how many people aren't doing this. Things like acupuncture, alcoholism treatment, ambulance, artificial limbs, birth control pills, braces, Braille, the list goes on and on. There are even special deductions for things like clarinet lessons and ballroom dancing. All it requires is a doctor's recommendation. We listed this in ABC, and it goes all the way down to Zyrtec. It's an enormous benefit, and if you're not currently taking advantage of this, it's costing thousands of dollars per year, and that's your client's money. Now, to make sure that we cover the fine print, an HRA is a non-discriminatory plan, which means you have to cover all full-time employees. If you have a company where you employ others beside your spouse, it might not be cost-effective to implement this strategy. Now, despite my saying it's non-discriminatory, the IRS publishes regulations on who you can discriminate against. It isn't special when the IRS says you can discriminate and they fail to tell you how to do it. You can discriminate against anyone who works for you less than 25 hours per week, anyone under the age of 25. You can eliminate anyone who works for you less than 7 months a year, and you don't have to cover anyone who has less than 3 years of employment within your company. And so that just makes this much more cash flow effective for the business owner. Now, when you're looking at doing an HRA, we really recommend using a good fiduciary and administrator, especially when you're handling reimbursements for non-related employees. There's IRS compliance, there's accounting and managing the account, and there are HIPAA laws that protect someone's privacy. And so it's really convenient for you to use an administrator directly with those medical expenses, someone who will track all of the documentation and produce the paperwork that you need at the end of the year. The administrator will also track all of the documentation and produce the paperwork that you need at the end of the year. It's nice to have one factor in your life that's simple and handled for you. Now, a lot of times I find when self-employed people do it themselves, it's very easy to mess up. Besides, you're better off focusing your time and energies on building your business. So we talked about an HRA, and that might not be appropriate. Now, the other alternative to get an immediate deduction is something called an HSA, otherwise known as a health savings account. Now, what is that? A health savings account doesn't cover as many things as the HRA, but in some ways it's easier. Essentially, what an HSA is you deposit a certain amount of money. I've got it up on the screen here, and you do that every year in a special account that's like a bank account. And then that money is immediately deductible. You get a 100% deduction for every dollar that you contribute. When you use the HSA to pay for various medical expenses that aren't covered by insurance, it's all tax-free. So effectively, you're getting a deduction for those medical expenses. Now, there are lots more things to cover in health savings accounts, so I encourage you to check out the course that we have on this topic. Just look for medical expenses. Now, let's talk about hiring kids to work in the business. Kids and dependent family members can be wonderful, and they can also be expensive. So let's talk about how your clients can deduct their kids' hobbies, education, weddings, sporting fees, etc. Here's how you do it. First, the business owner is going to hire their child to work in the business. With the income they make, they can pay for their own sports classes, clothes, etc. It's the equivalent of deducting those expenses. Let me explain a little bit more. The business is going to get the deduction for the wage that's paid, and the child receives that income and pays tax at their taxable rate, which ideally is less than the business owner. Now, payment for the services of a child, if it's done through a partnership or a sole proprietorship, and they're under the age of 18, they're not subject to Social Security and Medicare taxes, so that's a little boost. Currently, those taxes add up to 15.3%, so you can get an extra savings there when you make that election in a sole proprietorship or partnership owned by the parents. Now, any individual person can earn $13,850 a year before they have any income taxes owed. So that also includes children. So what that allows the business owner to do is transfer money from their tax rate, which is higher, and then transfer it to the kids' rate, which can be zero up to the first $13,850. Now, it doesn't have to just go for pizza and video games. You can set up a custodial account and use that account to pay for their classes, for their sports, for summer camps, and more. That means ultimate savings for the business owner. Now, here's an example. Let's say that you have a client who has a 10-year-old daughter who can stuff envelopes for mailing. They can take out the garbage, they can vacuum the office, and so forth. The business is going to pay her a reasonable wage over the course of the year, and let's say she earns $5,000. Now, if the business is going to keep $5,000, they're going to pay maybe $1,750 in taxes on that amount using average rates. But when they transfer this $5,000 to the daughter, she gets that full $5,000 tax-free, and then that can go to pay for the child's expenses. Now, of course, you can do this and assist your clients in doing this with all the children they have and actually multiply that benefit. I've got a friend that has 7 children, and now that's a lot of tax-free money to transfer over. Now, if you learn one great idea in tax planning, you can really reap those benefits and help your clients for years to come. So consider, with all of these strategies that we're discussing, it not only saves this money now, but every single year after that, and it's thousands of dollars in taxes per child. Now let's talk about the details. How do you actually accomplish this? There are critical factors, and this applies to hiring family members of any age, so whether it's a spouse or a child. You need to pay them a reasonable wage. Now, sorry, you can't pay them $100 an hour unless they're doing work where the going rate is $100 per hour. So how do you know what a reasonable wage is? You can look up the rates of an agency that would provide those services, or look for marketing and advertisements for the specific services that are being offered. Now, you can pay the same rate or less. So when you're advising your clients, I recommend having them do that legwork, so as the advisor, you are not being held liable for setting that reasonable rate. It really should come from the business owner. And that's because the IRS is very particular when family members are hired. Now, besides documenting that you're paying the child a reasonable wage, there are other documentation strategies for employing spouses and children. You really should keep timesheets because you need to be able to know what those hours are and what the person did. Remember, the burden of proof is always on the taxpayer. And when you get into tax planning, now there's a little more liability involved because you're getting paid more as the advisor. The person needs to be paid directly by check or use payroll services that can automatically deposit those funds into their own bank account. So if you offer payroll services in your practice, this is a great way to get more work in that area. Now, you can have them as a W-2 employee, not an independent contractor. So you want to make sure that you're meeting the IRS requirements. And in this case, they're clearly an employee. Make sure to file all of the necessary forms. Now, the child has to actually be able to do the work for the business, and they have to actually do it. If they aren't old enough or don't do the job, they can't be paid, and those payments cannot be deducted. Now, there's something called the kiddie tax that we need to be aware of. It's a tax on children who are under age 19 and can be up to age 24, depending on their dependency status. There's also a law with additional qualifications that we've got to follow. There's no hoops to jump through until after age 24, and at that point, they're always taxed on their bracket no matter what. But if they're under 24, there's a little bit of a catch. They've got to earn their income, which means be careful with investment income. If you're trying to shift investment income and think about things like interest, dividends, capital gains, they can only earn a little over $2,000 before they're taxed at their parents' highest income tax rate on that income. So that's not going to accomplish the same strategy that you're intending with hiring the kids to work in the business. So remember that with hiring your children, they're actually doing the work. With unearned income, such as investment income, be careful with the kiddie tax limitations, otherwise it won't create the tax savings. Now keep in mind you would be making gifts of these types of investments, so you also need to apply the gift tax rules. I hope this helps give you some ideas on how to share this with your clients and get them eager about working with you to save tax. If you're looking for more ways to save money for your clients, or you're looking how to incorporate tax advisory services into your practice, check out the website on the next screen.